The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Welcome to the Executive Share Schemes webinar, and I'd like to introduce firstly Mining Professionals Only, and then secondly Brett Cribb. My name is Andrew Lovett, and I'm a tax agent and accountant based in Brisbane. Mining Professionals Only is a joint venture between my firm, Lovett's, and Brett's financial planning firm, Far More Financial. Both Brett and I are engineers. Brett's a mining engineer and I'm a mechanical engineer by our original training. Both of us have changed careers into the financial field, and we both service executives of mining companies and also owners of mining services businesses. I'd now like to hand over to Brett to start through onto the webinar. Over to you, Brett.
Good afternoon, everyone. This webinar is another instalment in our webinar series for mining professionals, and our aim is to present useful financial information to you. We've helped executives over time with foreign tax consequences of exercise, timing of that exercise, advising about and implementation of protection strategies, implementation of exercise, ongoing administration, management and advice regarding multiple grants, advice regarding new employment and the implications of those proposed grants on your personal financial position, and advice to executives seeking employment re-proposing your future scheme grants and the potential fit within an organisation. Advice and implications regarding your personal financial future and the possible impact of a share or option scheme. So this webinar came about following a series of questions I received from various mining professionals in regard to should they exercise their options and seeing various tax consequences of each decision. On many occasions, the tax results could be completely counterintuitive. Some incentive plans allow you to choose between options or shares or a mixture thereof, but there are fewer of these since the legislation changes made in 2009 which made options less tax effective. I'm often asked, should I take shares or options, especially in early stage companies? And the choice generally comes down to your personal circumstances, and this webinar aims to explore some of those issues to consider in employee share schemes.
Sorry about the pop-up windows on our computer screen. Hopefully that won't happen again. I'll just move on now to the mandatory disclaimer.
So as you'll see from our presentation this afternoon, there are many complexities to employee share schemes. There's no way we can do them justice in this presentation, and it's important that you seek advice regarding your personal circumstances, as this presentation doesn't consider them. In short, just seek advice and don't act on what's been said here today without obtaining that personal advice. So today's webinar aims to provide you with the tips that will help you consider your executive employee share and option schemes and to be aware of some of the hidden traps associated with those schemes. The first thing we'll do today is review the differences between share and options grants. And there's a lot to consider: tax, timing and what to take up. Our aim is to assist you in understanding your executive and employee share and option schemes and how they may affect you and your personal financial future. So first, let's talk about some of the current environment for mining professionals, employee share schemes. So shares are now generally granted post the legislation in 2009 for Australian companies. Due to that change in the tax legislation, it made options less attractive.
Sorry everybody, just a few issues with the computer screen there. Hopefully it's working okay now.
However, many foreign companies and some small companies continue to issue options. They're a cheaper form of remuneration for shareholders, and however, they significantly increase the risk for the receiver, but potentially increase the reward as well, i.e. what I call leverage. I'll just go over some terminology that I'll use throughout the presentation today, and I'll do that by way of a simple example here. The key themes, though, the key terms are grant, vesting, and exercise. So if we just consider the easy option of Jill, who receives her annual bonus including 10,000 shares and 50,000 options in XYZ Mining, and the terms of which are the shares and options are granted, i.e. the grant, on the 1st of July 2013 at the annual bonus date. The shares also vest subject to remaining at the company in 3 years. So the 1st of July 2016 is the vesting date. And they vest with a 50% vesting if XYZ Mining achieves 75% of a performance clause, with a sliding scale up to 150% vesting for XYZ Mining achieving 125% of the performance target. Options. The options vest subject to remaining with the company in 3 years, and they have an exercise period of a further 3 years. So exercise period is 3 years. And the exercise price of the option is $2, which is the market price at the grant. So that's your exercise price, and your the vesting period is the same, 3 years.
Okay, so the first thing is the granting, and then the next is the vesting.
Yep.
And then for options, after vesting, you may have a point of exercise.
That's right.
Yep. Brett, before we go too much further, could you give our listeners a little bit of background about shares and options that get issued through employee share schemes?
Okay, Andrew. So let's first of all look at what an option is. An option is an issue of a right to acquire a share at a certain price in the future. Sorry, I may well have just jumped myself around here. No, that's correct. Sorry, I'm right on the right track. An option is an issue of a right to acquire a share at a certain price in the future with a vesting date and an expiry date. Due to Australian tax legislation changed in 2009, they've become less favoured. And the reason they've become less favoured is that they are taxed at vesting, which causes most people to have to exercise the option and sell the resulting share to pay the tax bill. So Andrew, would you explain to our listeners how options are taxed on vesting?
Brett, there's a detailed calculation that's set out in the taxation regulations, and it has some tables there that consider how much difference there is between the exercise price and the current market value, and also considers the time, the exercise period. So by a combination of those factors, a market value is derived under those tables for the option, and that's how the tax is calculated.
And it's important to note that in many foreign countries, tax will apply on that exercise as well, and it often is as a withholding tax. So I'll talk about that a bit later. Andrew, what about if an option has a strike price of $3.50 and the shares are worth $3 at that time, and the option's got an expiry some years into the future?
Okay, we've seen this circumstance arise recently for some corporate mergers that have taken place where there's been employee share scheme options that are out of the money. In other words, it'll cost you more to exercise the option than it would to buy the underlying share. And if we have a vesting of those options at that date, it is still possible, even though the option's out of the money, it's still possible that there will be a tax market value attributed to the option because it may have many years yet left to its expiry, and it may be that it becomes in the money during that remaining expiry period. So there can still be tax consequences if options that are out of the money vest.
And as I commented before, if you are any withholding tax is paid, it'll often cause you to have to sell shares, or the company sells the shares for you, and that causes a further tax payable in Australia for an Australian tax resident. This particularly relates to professionals who move between countries for assignments and stay with the same company. For example, you could spend a few years in Canada and then move back to Australia, and that will likely apply. So when exercising options, sometimes the results can be quite counterintuitive. So for example, would your after-tax position be improved by paying more tax? On many occasions I've found that it does, assuming the share price rises into the future, and on exercise you need to sell enough shares to fund the exercise of options. By delaying the exercise of options, you can often create more after-tax value but pay more tax. Ordinarily you might expect to exercise early to pay less tax, but by delaying the exercise you'll pay more tax but realise more value after tax as you retain the exposure to the upside. You might also have schemes you've paid tax on in Australia but not in a foreign jurisdiction where you previously worked. So should you hold the shares in the scheme knowing you'll pay more tax in the future if the share price increases, or pay the lesser tax now? So we assist our clients manage their complex employee share scheme needs, and it's important to seek advice. If you need assistance to understand your advice needs or to obtain a review of your employee share scheme options, please call our office. So I'll now talk about shares. And looking at what an issue of shares under an employee share scheme often is, it's an issue of a right to acquire a share at a certain price, which is generally zero, in the future with a vesting date and an expiry date. Due to Australian tax legislation change in 2009, the issue of shares has become a lot more favoured. Andrew, would you explain to our listeners how and when shares are taxed?
Sure. So the fundamental idea of employee share schemes is, from the employer's perspective, it provides motivation for high job performance. The company then has got motivated executives and employees and does very well. The employee or the executive benefits from receiving shares, or we've just gone through options previously, but if we talk about shares, they'll benefit from receiving those shares at no cost or possibly at a very low cost in some circumstances. So otherwise, if the executive wanted to buy shares, they'd have to pay the prevailing market price. So under the share scheme, may pay no price or a low price, otherwise would have to pay the market price. The tax rules treat the discount from the market price as income in the hands of the employee. The discount is the difference between what you pay, or it may be nil, and the prevailing market price. When shares are originally granted, as Brett explained before, it's not certain how many of those shares that you'll actually end up getting, or indeed will you get any or all of them, because there are usually performance benchmarks that have got to be met. So it's usually, in those circumstances, possible to defer the taxation point from the grant date to what they call the vesting date. And vesting is when there's no longer any real risk of forfeiture of the shares, and you are free to sell them, basically. So that's usually under executives' employee share plan schemes the taxation point when they vest. Under other deferred taxation points, there is deferred taxation points, which is the elapse of 7 years from the original grant date, or if your employment terminates. So the tax rules cause those to be a taxation point if the vesting hasn't happened beforehand. In addition to that, for some small employee share plan allotments, you might elect to be taxed up front, as you may be able to receive a $1,000 exemption. So in some circumstances, people will elect to be taxed up front, but it's generally only for smaller amounts. Now, the employer is required, since the changes in 2009, the employer is required to give you, in effect, a summary, which looks a little bit like a PAYG payments summary, which tells you what the discount was that's got to be included in your tax return for tax purposes. And the further thing is that if after your shares have vested, if you keep some or all of them for a further period of time, you don't sell them all at that point in time, and there is a further gain in the value of the shares on the market, well, it may be that you're also up for a further capital gains tax bill that's based on the increase in value from the value at the discount point at the vesting to the value when you eventually sell them. So that gain thereafter would be a capital gain. If you hold them for 12 months, you may be able to get the 12-month 50% CGT discount, but nonetheless there may well be a second taxation point.
Okay, thanks Andrew. So the same comments apply to shares as options, and if you have any withholding tax paid in foreign jurisdictions, often the shares will be sold for you to pay that withholding tax bill, and that'll cause further tax in Australia. And again, it relates to the same example I gave before of people moving between different countries. So let's now talk about the risks and benefits associated with shares and options under employee share schemes. So leverage, or in other words, does a small movement in the underlying share price produce a larger gain? Is a word that I often use for share schemes. When issuing shares, you've got limited downside but also limited upside. So generally, the shares will always lead to some value for a mining professional. With options, there's a lot of leverage involved. It maximises upsides, but also you run the risk of a complete loss, in other words, receiving nothing. Consideration around company issues, if you're considering employment with a company, the company will consider that shares are more expensive to issue and options are relatively inexpensive for a company to issue. You'll generally find with shares it'll be a more established company wanting to retain staff, and options it'll generally be an early stage company with exploration or development phase, and it's for people wanting to gain quite an exposure to the leverage where an increasing share price is considered more likely. With employee retention, you'll generally find with shares there's more limited downside, and it ensures that there will always be some sort of incentive to remain with the company as each annual grant continues to vest. So shares with value will always provide some value at each vesting period, which provides quite a significant incentive to remain with the current employer, like a golden handcuff. With options, there's a risk of a complete loss, which can remove all incentive for any employee. So if you're considering new employment, you may want to consider taking up shares where there's less ability for you to materially affect the share price. And if you're given the option of choosing some options, it might also help to demonstrate your intent to gain as much leverage as possible to the company. With tax, I'll discuss in the remainder of our presentation. So one of the other issues to consider for employee share scheme participants is the tax and timing of the payment of tax. So as we discussed before, generally tax is at the vesting date. And vesting we often find is 2 to 3 years after the grant date, so when you first receive the options in the grant or shares in the grant. There's some first year considerations to consider. So the first year they vest to you, you'll have that tax liability to pay once your tax return is submitted. and that will generally incur a further PAYG liability going forward. So you need to consider the cash flow considerations around that. They can be quite complex, but enough to say that it will trigger another liability going forward, in addition to the tax you have to pay for that year. Or a possible liability, I should say, but it will trigger a PAYG statement issue. When you have multiple jurisdictions, you need to consider the impact of tax in different countries, and that may cause you to delay or realise tax at different points in time. We can take you through these to help you determine a strategy which suits your personal circumstances. So finally, let's cover off on 6 points to consider. In the event you have the choice to choose shares or options or a mixture thereof, at Far More Financial Group we've listed 6 points to consider to help you understand your options. First one's consult a professional advisor. You need to find out about the available options, and you'll need help with your decision making. The next one is, if you're considering a new role, are you aligned with the company's objectives and executive incentive scheme? In other words, shares or options, which one might be better for you? Step 3 is, how much leverage do you desire? If you have to choose between or a combination of shares or options, ask yourself which way and by how much do you think the share price is headed, and whether significant gain is possible or probable. Step 4 is, would you prefer more certainty? Would you prefer the certainty of shares or possible blue sky of options? Step 5 is, will you hold options on vesting, and can you pay the tax if you have to hold them? And step 6 is the timing of tax. So when will you have to pay the tax and the quarterly liabilities? Again, we can take you through these points to help you decide on options which suit your personal circumstances. So there's certainly a lot to digest from this presentation and needs your careful consideration. We've developed expertise in helping mining professionals, and we partner with Lovett Consulting Accountants who have experience in working with mining-specific tax and accounting matters. Together we can assist you in your decision making. We understand that employee share schemes can be complex, especially when multiple jurisdictions are involved. There can be significant taxation complications and consequences. With careful planning and good advice, employee share schemes can deliver significant personal and financial benefits. For more information and to discuss how these and other strategies may be applied to your personal situation, to make it happen, I invite you to contact me. Thank you everyone for your time today. We look forward to our next webinar presentation.